May 1, 1970. Balbriggan, County Dublin. John Dempsey opens his pub and finds, behind the bar, a drawer full of paper, cheques, hundreds of them, thousands of pounds. The banks had been closed for weeks. He is holding what the banks used to hold. He is not worried. He tells a Bank of England researcher. He deals only with regulars. He refuses strangers. He has, he says, kept a few local factories going. 6 months later, economists will look at the retail sales data and call this a success. The Central Bank of Ireland survey of 1971 tells a different story. This is not fiction. This was Ireland, 1970. Here's what blows people's minds. Ireland's bank strike is remembered as proof that a modern economy can function without banks. Not really. What it actually proved is narrower, harder, and more dangerous. For a limited period, in a country dense with local familiarity, publicans and shopkeepers could keep checks moving between people they already knew. That is not the same thing as replacing a banking system. It is a temporary suspension bridge made of reputation. And John Dempsey is the whole mechanism in one man. He is not evaluating collateral. He is not clearing payments. He is not transforming maturity. He is doing something older than that. He is recognizing names, faces, wage patterns, factory routines. He knows who drinks here, who gets paid on Friday, who is good for it. So the famous Irish resilience story begins in the wrong place, not with national strength, with local selectivity, because Dempsey's line matters more than the folklore built around it. I refuse strangers. That is the part the official memory softens. He kept business moving, yes, but only for the people already inside the circle. And once you see that, the whole story changes. The closure itself did not come out of nowhere. That matters, because one reason the strike later looks survivable is that parts of the economy had already been bending around banking dysfunction before the official shutdown began. The four associated banks, Bank of Ireland, Allied Irish Banks, Northern Bank, and Ulster Bank, closed together on April 30th, 1970. Between them, they controlled roughly 640 branches and around 60% of Irish deposits. That sounds like a sudden amputation. And formally, it was. But the working system had already been degrading for months. Since February, bank staff had been working shortened hours. Backlogs were building. Checks were taking longer to clear. Paper was piling up before the doors shut. So when later commentators described the strike as evidence that the economy continued to function for a reasonably long period of time, they were describing an economy that had already begun improvising around friction, delay, and missing settlement capacity, not a clean economy abruptly asked to prove it did not need banks. That distinction is everything. Because if you close a system after people have already started routing around it, you are not testing the system at full dependence. You are testing it after adaptation has already begun. And adaptation is not the same as resilience. Go back to Dempsey. By the time the strike is fully underway, he is not inventing a new credit order. He is absorbing overflow. Paper that would normally sit inside a branch ledger is now sitting in a pub drawer in Balbriggan. He can do that because the paper is attached to names he knows. Factory workers, local employers, men whose wages, habits, and reputations are legible to him at street level. That is why the romantic version of this story is so misleading. It was never Ireland carried on without banks. It was, certain towns for a while, rerouted trust through local intermediaries who already possessed social intelligence the banks used to formalize. Very different claim, and the timing made that claim look stronger than it was. If the banks had closed without warning in February, before shortened hours, before workarounds, before check circulation had widened, the stress would have looked different, sharper, more immediate, possibly less survivable. That is an inference from the structure of the event, but it is a strong one. The preconditions for apparent stability were built into the calendar, so the first forensic correction is simple. Ireland in 1970 did not discover that banks were optional. It discovered that settlement can be deferred for a while when trust is local, paper is familiar, and the closure begins after the economy has already started learning how to limp. That is not triumph. It is grace period. The mainstream narrative forms in one sentence. In the Central Bank of Ireland Annual Report, 1971, the bank states that the Irish economy continued to function for a reasonably long period of time during the strike. That line is true in the narrowest possible sense, and wildly misleading in the way it was later remembered, because the sentence survived. The surrounding evidence did not. What made the legend possible was the metric underneath it. Retail sales. Goods still moved. Shops still traded. Pubs and local businesses still accepted checks in places where trust already existed. So from a distance, the organism appeared alive. But retail sales are a surface indicator. They tell you that transactions happened. They do not tell you how much labor was diverted just to keep wages paid. They do not tell you whether a builder canceled expansion because cash flow became too uncertain. They do not tell you that title deeds sat trapped inside bank vaults while property transactions froze. They do not tell you whether a check was genuinely liquid or merely being treated, temporarily, as if it were. Those are different things. Let me be precise about what happened to the story. A technical observation became folklore. First, the report noted that basic economic activity continued for longer than many expected. Fair enough. Then that observation was detached from its conditions, detached from geography, detached from exclusion, detached from fraud, detached from the fact that an economy can look functional in shop tills while decay spreads underneath in credit, hiring, investment, and settlement. Once stripped of those details, the sentence turned into a myth. Ireland proved banks are not essential. It proved no such thing. And this is where John Dempsey matters again. Economists looking at aggregate sales could see checks circulating. Dempsey could see the precondition underneath the circulation. He knew exactly why one check could pass and another could not. One had a known man behind it, a known employer, a known pattern of payment. The other came from a stranger. That is the hidden mechanism the headline missed. The system did not function because formal finance had become unnecessary. It functioned because thousands of local gatekeepers informally priced trust using private knowledge. Human balance sheets, human memory, human vetoes. That kind of system can keep bread moving for a while, but it cannot be scaled cleanly. It cannot settle risk transparently, and it cannot include everyone. So when you hear that Ireland survived the bank strike, the first question is not whether shops stayed open. It is this: what vanished from view when economists chose the wrong lens? Here's the cost the success story hides. A building contractor, cited in the 1971 Central Bank Survey and discussed later by researchers, put it plainly: I employ only 10 people. If it hadn't been for the bank strike, I'd be hiring 30. Another reported losing £20,000. Others spent days each week doing something that does not appear in retail sales at all, scrambling for wage cash instead of building, selling, hiring, or investing. That is what a financial breakdown looks like before the headline numbers fully register it, not empty shells first. Misused time. A functioning banking system does not just store deposits. It compresses search. It compresses searchant. It compresses settlement. It compresses uncertainty. Once it disappears, somebody has to replace those functions manually. In Ireland in 1970, that somebody was often an employer, a publican, a shopkeeper, or a local wholesaler. And the cost was not only monetary, it was cognitive, logistical, emotional. 3 days a week trying to assemble payroll is 3 days not spent growing a business. So yes, trade continued, but at a different cost structure and in a very uneven geography. The informal substitute system rested on roughly 23,000 pubs and shops acting as local clearing points, but only where prior relationships already existed. Dense communities could improvise because information was social. People knew who worked where, who got paid regularly, who could be trusted to settle later. But outside those zones, for the newly arrived, the geographically isolated, the less connected, the less legible. The substitute system was weaker or absent altogether. That is why John Dempsey's rule is not a colorful detail. It is the exclusion clause. I refuse strangers. There it is. The whole substitute architecture in 6 syllables. If you were known, your check might circulate. If you were not known, your paper was just paper. The famous Irish workaround was not open access community solidarity. It was rationed trust, and you can see the limits where that trust failed. The central bank recorded 750 fraud cases during and after the strike. Stock exchange volume fell by roughly a third. Property transfers stalled because title documents were held inside bank vaults and could not be accessed. Retail activity could continue while capital formation, asset transfer, and formal verification froze underneath it. That is the distinction most retellings erase. An economy is not healthy because pints are poured and groceries are sold. The deeper question is whether claims can be verified, whether ownership can be transferred, whether hiring can expand, whether strangers can transact, whether risk can be priced without personal familiarity. In Balbriggan, Dempsey could keep some factories going, but he could not make an anonymous society work. Nobody could. Here is the buried lead. The Irish strike is usually remembered as a demonstration of social resilience, but the deeper forensic finding is the opposite. The system was becoming more dangerous with every passing week. As later research put it, the absence of a proper settlement mechanism implied that risks were rising for almost all transactors. That sentence should have replaced the folklore, because once you remove formal settlement, you do not remove risk. You displace it. Then you hide it inside private trust, delayed clearance, and paper claims nobody can finally verify until the banks reopen. So the longer the strike lasted, the less stable the workaround became. Not more stable, less. The uncleared check mountain kept growing. By the end, it reached about £3 billion, roughly 3 times Irish GDP at the time, according to the research trail behind this episode. Think about what that means. A society was passing paper hand to hand on the assumption that final settlement would eventually arrive and validate the chain retroactively. That works only while confidence holds. And while the horizon is short, add 1 more week and fraud risk compounds. Add another and trade counterparties grow cautious. Add another and foreign suppliers begin tightening or withdrawing credit because the normal channels of assurance are gone. What looked, from inside Ireland, like a creative substitute for banking, was in fact a countdown clock attached to a backlog. And this is why the strike's ending matters so much. It ended before the full failure curve arrived. That is not a minor detail. It is the entire interpretation. The mainstream narrative was only possible because the stress test stopped early enough for the system's hidden fragility to remain partly theoretical. Had the closure continued much longer, the celebrated trust network would likely have been remembered differently, not as proof of endurance, but as proof that informal credit can bridge a gap only until accumulated uncertainty outruns reputation. Go back to John Dempsey. His drawer worked because settlements still had an end date, even if nobody knew exactly when. Remove that assumption, and the drawer changes character. It stops being a bridge. It becomes a trap. And the pattern did not stay in 1970. In February 2023, in Kaduna State, Nigeria, a fruit trader named Odbogo Moses watched the same mechanism appear in a harsher form. The central bank invalidated old Naira notes before enough replacement cash had reached the economy. Her customer volume fell by about half. Her stock orders fell with it, and this happened inside an economy where the informal sector accounted for about 65% of GDP, about 93% of employment, and where cash still dominated daily trade. Headline: GDP moved far less dramatically than lived reality on the street. Same fracture, same illusion. Macro data captures the formal sector's partial adaptation. It misses the people outside the settlement infrastructure. That is why the Irish case matters now. Not because it proves you do not need banks. Because it shows what really replaces them when they fail. Not a neutral market, not a seamless community, but a hierarchy of trust. Some people get carried across, others do not. The difference is rarely visible in the first headline, and the people inside the substitute system learned that lesson faster than the economists did. By 1976, when another Irish bank strike arrived, publicans had a sign ready. When the banks start serving booze, we will start cashing checks. They had already run the experiment once. They knew what the folklore left out. So here's the survival conclusion. When the formal system breaks, your first question is not whether commerce will continue. It will, somewhere. For someone, your real question is whether you are already known inside the network that decides whose paper still counts. That is the binary choice, inside the circle or outside the drawer.